Have you ever wondered why some people seem to make money in the stock market even when the economy is crashing, while others lose everything? What if I told you that you could build a portfolio that doesn't just survive crashes, but actually grows consistently over time? Today, we're diving into a strategy that has quietly made ordinary investors wealthy, the 4 ETF portfolio. And the best part? It's simple, easy to follow, and designed to weather even the stormiest markets. Stick around, because by the end of this video, you'll understand how to set up this portfolio for yourself and why it could be your ticket to financial freedom.
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Let's start with the basics. An ETF, or exchange-traded fund, is like a basket of investments that you can buy in one single trade. Instead of picking individual stocks, which can be risky and time-consuming, ETFs allow you to invest in many companies or bonds at once. Now, why 4 ETFs? Why not 10 or 50? The secret here is simplicity and balance. Too many ETFs, and you're just overcomplicating things. Too few, and you might be taking on unnecessary risk. With the right 4, you can cover all the major areas of the market, balance growth with safety, and reduce the impact of market crashes. So, what are the 4 ETFs that make this portfolio so powerful? The first is a total stock market ETF. This ETF gives you exposure to the entire stock market, including small, medium, and large companies. It's the engine of growth in your portfolio. Historically, the U.S. stock market has returned around 10% per year on average. That doesn't mean it goes up every single year, but over the long term, it's been an incredible wealth builder. The second ETF is an international stock market ETF. Why invest internationally? Well, the U.S. market is powerful, but it's not the only engine of global growth. By adding international stocks, you diversify your portfolio across different economies, currencies, and industries. This means if one country's market crashes, your entire portfolio doesn't take a nosedive. International diversification is like having multiple engines on a plane. You're less likely to crash if one engine fails. The third ETF is a bond ETF. Stocks are great for growth, but they're also volatile. Bonds, on the other hand, are generally safer and provide stability. When stocks drop, bonds often go up or at least hold their value. This is the cushion that protects your portfolio when the market gets rough. Think of bonds as the brakes and airbags for your investment car. They won't make you rich on their own, but they keep you safe while your stocks do the heavy lifting. The fourth ETF is a gold or commodity ETF. You might be wondering, why gold? Gold has been a store of value for thousands of years. During times of economic uncertainty, inflation, or geopolitical tension, gold often rises when other assets fall. By adding a small portion of gold to your portfolio, you add another layer of protection. It's not just about growth, it's about survival. Now, how do you balance these 4 ETFs? A classic allocation is 40% total stock market, 20% international stocks, 30% bonds, and 10% gold. This is a balanced approach designed to maximize growth while minimizing risk. But here's the interesting part. You can adjust this allocation based on your risk tolerance. If you're younger and can handle more ups and downs, you might increase your stock allocation. If you're closer to retirement and want safety, increase your bonds. The flexibility of this portfolio is what makes it so powerful. Let's talk about what happens during a market crash. Imagine the stock market drops 30%. Your total stock market ETF and international ETF will lose value, but your bond ETF and gold ETF act as shock absorbers. They reduce the impact of losses and sometimes even increase in value, helping your portfolio recover faster. Over time, this approach helps investors avoid panic selling and lets their money grow steadily. Now here's a question for you. If you had this portfolio during the 2008 financial crisis, what do you think would have happened to your money? Drop your thoughts in the comment section below. I'd love to hear your predictions. Do you think you would have panicked, or would this portfolio have helped you stay calm? Another powerful aspect of the 4 ETF strategy is rebalancing. Rebalancing means adjusting your portfolio back to your original percentages whenever they drift too far due to market movements. For example, if stocks rise faster than bonds, they might make up 50% of your portfolio instead of 40%. By selling some stocks and buying bonds, you maintain your risk level and lock in profits. This simple step is like tuning a car. It keeps your portfolio running smoothly without surprises. Consistency is key. The 4 ETF portfolio works best when you invest regularly and think long-term. You're not trying to time the market or predict crashes. You're following a system that has historically rewarded patience. Over decades, this approach has made many ordinary investors rich, even if they weren't constantly watching the market. I want to ask you another question here. Do you think it's possible for someone to retire wealthy with just 4 ETFs? Think about it and leave your answer in the comments. I'm curious to see your thoughts. Let's also talk about simplicity and mental peace. Many investors stress themselves out by constantly checking stock prices, reading market news, and trying to guess the next big trend. With the 4 ETF portfolio, you can step back, breathe, and trust the system. It's not exciting in the short term, but it's effective in the long term. Would you rather stress every day over individual stocks or watch your portfolio grow steadily over years? Let me know your choice in the comments. I promise it's okay to be honest. Here's another thing that makes this portfolio amazing. It's easy to set up and maintain. You can open a brokerage account, buy these 4 ETFs, and then schedule automatic investments each month. That's it. No complicated stock picking, no constant research, no emotional roller coaster. Just steady, consistent investing. And here's a little secret that many successful investors know. During market crashes, the best time to invest is actually when fear is high. When everyone else is selling in panic, your system is quietly buying more shares at lower prices. This is how wealth is built over decades. Remember, it's not about timing perfectly. It's about being consistent and disciplined. If you're finding this video helpful so far, don't forget to hit that like button, subscribe for more amazing content, and share this video with someone who's serious about growing their wealth. Your support helps me keep creating videos like this. And trust me, you won't want to miss what's coming next. Let's talk numbers. Imagine you start with $10,000 and invest $500 every month in this 4 ETF portfolio. If the average annual return is around 8%, which is reasonable with this mix, you could have over $1 million in 30 years. And that's even if the market has crashes along the way. Compounding is incredibly powerful. Money invested today grows over time, and the earlier you start, the bigger the payoff. Another question for you. If you started this portfolio today, how much do you think it could grow in 20 or 30 years? Drop your answers in the comments. I'd love to see your estimates. Sometimes thinking long-term changes the way we view money entirely. You might be asking yourself, but what if the market crashes tomorrow? Isn't that scary? Here's the truth. Crashes are scary if you're unprepared. But with the 4 ETF portfolio, you're prepared. Stocks may fall, but bonds and gold cushion your losses. You won't double your money overnight, but you won't lose your life savings either. This is what separates long-term winners from panic sellers. And here's something else to consider. Taxes. If you hold your ETFs in tax-advantaged accounts like IRAs or 401ks, you can grow your wealth faster because you won't pay taxes on every trade. Even if you're investing in a regular brokerage account, ETFs are generally tax-efficient compared to individual stocks. This is another reason why the 4 ETF portfolio is such a smart choice. Let's recap. 1. Total stock market ETF for growth. 2. International stock market ETF for diversification. 3. Bond ETF for stability. And 4. Gold ETF for protection. Balanced allocation, consistent investing, and periodic rebalancing are what make this strategy powerful. It's simple, low stress, and historically effective. Before we finish, I want to ask you one last question. If you could start this portfolio today, knowing it has the potential to make you financially secure, would you do it? Think carefully and leave your answer in the comments. I'm really curious how many people would take action. To wrap things up, the 4 ETF portfolio is not a get-rich-quick scheme. It's a long-term strategy built on diversification, balance, and patience. It's designed to survive crashes, reduce stress, and still help you build serious wealth. You don't need a finance degree, you don't need to constantly watch the news, and you don't need to be a market expert. You just need discipline and consistency. If you enjoyed this video, please like, subscribe, and share it for more amazing content on investing strategies that actually work. And remember, leave your thoughts in the comments. I read every single one and love seeing your insights. Start today, stick with the system, and watch time turn your money into wealth. Now here's a question that might keep you thinking for days. If you could guarantee financial freedom in 30 years with this portfolio, would you start today or wait for the perfect moment? Drop your answer below. I'm really curious what most people would do. Your journey to financial independence could start with just 4 ETFs.